Well, a couple of recent deals that we've sold, we've seen, multiple years of interest only, 5, 7, even more sometimes for select sponsors. Low threes on the interest rate, kind of depending.
Hey guys, welcome back to How to Invest in Commercial Real Estate. Today is a special two-part episode where we've got a special guest. I'm going to tee it over to Joel. He's going to introduce him.
Yeah, man, I'm excited to introduce Brandon Lamb with Newmark. He is a good friend of mine. I had the pleasure to work with him a little bit on the brokerage side a few years ago, and they are absolutely killing it on the multifamily brokerage side here in Oklahoma. He has a partner, Tim McKay, who's also incredible, and a whole team that supports you, which is important. But I just want to mention a couple of things they've got going on. They control 90% of the Class A sales of multifamily in Oklahoma, which is complete dominance. And then a couple other things. They also have the record for largest portfolio sale, $153 million. And that's not a huge deal in New York, but in Oklahoma, that's a pretty big deal.
That's a big deal.
And then they set the per unit price in Oklahoma at $220,000 a door, which compare that to some of our first units we bought at $9,000 a unit. That's also a big deal. But Brandon, welcome to the show. Glad to have you on. Tell us a little bit about how you got into commercial brokerage.
Yeah, guys, thanks for having me, first of all. So I have been with Newmark and the predecessor firm, which was ARA, for about 10 years. And prior to that, my career really started in commercial banking, and actually prior to that, selling securities. But, my timing was impeccable. I decided in about early 2008 that I wanted to be a commercial real estate broker. So
was that during the crash was already in full flow?
It was not. No.
Okay.
So everything was just going
okay. So you were
well.
Okay. Gotcha.
And I thought, man, I want to do that. So went to Stan Johnson Company.
Yep.
And great firm, and learned a lot. And about 2 months later, the cliff came. So I found myself thinking, man, I made a huge mistake. But success is a terrible teacher. You really learn in the midst of, a lot of adversity. So I didn't realize that in the moment. But, looking back, that was probably the best learning experience I had, was during that 2-year time frame. I ended up, late 2009, early 2010, finding that window of opportunity to broker distressed debt. Similar to the atmosphere today, but it lagged about 2 years. 2010 was the window of opportunity, and kind of parlayed some of those former banking relationships into saying, hey, KeyBank, Huntington National Bank, some of the bigger guys that were selling distressed loan portfolios, I've got buyers. So I started doing that on my own, laptop, in my spare bedroom, cell phone, and ended up having a monster year.
Was it sub-performing multifamily or another?
No, it was not. It was really not multifamily at all. It was just all food groups of commercial real estate. So, there were some multifamily deals here and there, but, it was really hard to find the non-performing, loans that most of those aggressive buyers wanted. So it was, shopping centers in Florida, or, and it was paper. We weren't really brokering real estate. It was really just,
So the buyer would have to come in and foreclose on it or something.
That's
afterwards.
Right. Yeah, foreclose, redevelop. That kind of thing. So during that time, I decided, I want to be an apartment syndicator. I always had an interest in apartments. You and I talked about that for years. And, I decided that's what I wanted to do. And, kind of playing in that space, contacting different brokers, made a relationship at ARA down in Dallas with the principal there. And at the same time, they had really shown some interest in opening an Oklahoma office. And we started talking about that, and that's how it came to be.
Very cool.
Nice. And that's when you guys kind of met, right? You guys met up at ARA. You kind of helped to open the Little Rock branch or something like that.
So it was a few years after you started at ARA, maybe a couple of years or whatever. We were kind of starting to have some success in precision equity, and so I was about to quit the day job and go full time with real estate. And right about that time, you guys were expanding, and you had brought on Tim McKay, who, I'll plug him, is one of the best brokers I've ever worked with.
Absolutely.
Guy is awesome. But yeah, and you said, hey, come help us with B and C class stuff. So for about a couple of years, I was helping them at ARA, which now is Newmark. So
right.
And you said you initially got into it because you wanted to do apartment syndications, but I think a lot of people know you more from the apartment brokerage. So walk us through the transition of, kind of what you walked in at and what you're doing now.
Yeah, so coming in, I knew no one in the Oklahoma multifamily space. So that was a pretty daunting task. It was just me sitting in a little executive office, didn't know anyone, didn't really know much about, the landscape at all in terms of apartments in Oklahoma. So I knew I had a pretty big uphill climb. I recognized pretty quickly what I want to do primarily is build a team with guys who do have relationships. So actually made a good run my first year. It was really just establishing relationships, which that's, the core of being a broker. It's a relationship business.
Mm-hmm. There's a lot that still gets done in a handshake for sure.
Absolutely. So, and, we rely on that to this day. I mean, it's just, the bigger listings we get, it's relational. We really, we do some life with a lot of our clients and really, have some good relationships there. So fast forward 1 year, I met Tim McKay, who is, like you said, I don't know anybody better in our business in terms of, he's a hard charger. He's a giant slayer. I mean, the guy is the best in that institutional space, Class A space, the best that I've known.
Well,
so
he
what he does than him.
Yeah, I think back. What impressed me about him is that he just got the Rolodex out and says, "I'm going to figure out who every single apartment owner is in our market, in my market, and I'm going to know each and every one of them by name. I'm going to send them emails weekly, and they're going to know that I know what I'm doing." He would send them articles, establishing himself as someone that knew the Oklahoma City market better than anybody else.
Yeah.
And that was really impressive.
That's right. So yeah, I couldn't have asked for a better partner. That was about 2013. And then fast forward a couple more years, we were acquired. ARA was acquired by Newmark Knight Frank. So, that was kind of a pause moment to try to figure out, is this a good thing? Is this a bad thing? Turned out to be a phenomenal thing for us. We then expanded our bandwidth even more.
That gave you more, kind of notoriety, a bigger flag, or what was?
Well, in the apartment space, ARA was incredibly well known. They were a privately held firm, but they were a big deal in the apartment space. But yeah, absolutely, it expanded our bandwidth to do a lot of different things that we didn't have the capability to do before. So from a broker's standpoint, the culture there is phenomenal, but it also allowed us to bring on, the additional Newmark affiliate team in Oklahoma City. Mm-hmm. And that was a game changer for us as well. It had, multiplied our market share even more. And it really allowed us to really kind of put things in silos instead of, I'm going out and chasing every deal. I'm going to become even more of a specialist in, Class A institutional deals. This guy is going to chase workforce housing. This guy is going to focus on private client space, which is basically 5 million and sub 5 million. Mm-hmm. So that really was a game changer for us.
It sounds eerie, familiar. Neil was on saying that same thing about how he just compartmentalized his brokers and forced them to niche down and really be the expert on what they're at. And like you said, a lot of it's a relational thing. And when you've got 7 guys trying to keep up with the same relationship, it gets confusing and it gets muddled on the client side. Whereas if you just have that one person who's in charge of that relationship and can handle everything with them, I think that's great.
Yeah, absolutely.
So I really want to dive deep into why multifamily is such a hot investment class. Multifamily, 5-7 years ago, you could find it everywhere. It was relatively inexpensive compared to other asset classes. You could find it in a lot of markets, and it was really kind of this hidden gem of house flipping is what it seemed like. And, a lot of people got into apartment flipping, which is just house flipping on a bigger thing, right? You buy cheap apartments, you improve them, you stabilize income, you make it make more income, and then you sell it. So why is there so much competition? Why are we seeing, $150 million portfolios sold? I mean,
setting new record unit prices.
Yeah. What is it about multifamily in Oklahoma of all places and everywhere really? Like what's driving them to Oklahoma? Just everything.
Yeah. Well, pre-pandemic, what we saw was, it got to be such a competitive space based on, we perceive this to be recession-proof. Debt terms are incredible. Just that kind of atmosphere started driving international capital to the gateway markets. and, call it the coastal markets. And then it became so competitive and people just couldn't win deals out there. They started driving them to the middle part of the country. So first they're looking in Dallas or Austin or Houston, those bigger primary markets, and the same phenomenon would happen there. Our Dallas brokers, again, pre-pandemic, were getting probably an average of 40 to 50 offers on every single deal. Wow. So there were lots of, call it all the bridesmaids were just like, man, how do I win a deal? How do I get any yield whatsoever? So we would really capitalize on that and say, hey, we need to tell you the story of Oklahoma City or Tulsa or Northwest Arkansas, which is a phenomenal story in and of itself. But
we've got to stop there. So you were brokering deals in Dallas, and then you were saying, hey, if you want yield, if you want good apartments, if you're tired of losing, you got to come see what we've got in Oklahoma. You'll think it's a gold mine.
Yeah. So we weren't doing the brokerage in Dallas, but we have a Dallas team, obviously a Dallas office, and we work hand in hand with a lot of our offices around the country. So we're always in tune with, hey, who's buying in your markets? If they like this market, they should like our market as well. So we're constantly collaborating with those offices, and that's exactly how we bring so many new to market buyers into Tulsa, into Oklahoma City, and all of our markets, because they're saying, well, I don't know much about Northwest Arkansas. Tell me the story. And they love what they see. They get better yields. It's less competition. We think we get a lot of offers on every deal. We might get 15 to 20, but they say, well, I'm not competing against 50 guys anymore. I'm competing against 15 or 20. I can handle that. I can get better yield. I like the story, et cetera.
Okay. So the basis of it, there's good debt, and it's relatively predictable, and people have to live there, so it's probably the first check they're going to pay. So this institutional capital, that's all for them. I mean, I guess it's a lot safer than, not a lot safer, but it's a lot less volatile than the other asset classes, I guess, is the really attractive piece.
Did you see post-pandemic, I haven't really seen a price drop in multifamily. So maybe an initial scare, but it seems like now there's just as much capital back at multifamily. And I think maybe some of it's coming from retail, making a shift. Any thoughts on that?
No, absolutely. And believe it or not, it's gotten even more aggressive from a buyer's standpoint. It seems like, the last year or so, there's been less to sell. It's not the issue is not buyer appetite. Buyers are very, very bullish right now for multifamily. Debt terms are better than I've ever seen them.
What are you seeing out there? Let's just talk about that real quick.
The high prices aren't scaring people away necessarily?
Not right now. I think to your point, Joel, I think we've seen a lot of guys who weren't even in the space. Well, we're retail investors, we're hotel investors, whatever it may be. Those sectors that are in pain right now, post-pandemic, are saying, man, maybe we should be looking in the multifamily space. So we're seeing kind of new funds, rise up. A lot of the institutional and quasi-institutional players are saying, maybe we should look at Oklahoma or Northwest Arkansas.
What's going back to the debt, because that's going to help driving the value. What are you seeing on debt terms these days?
Well, a couple of recent deals that we've sold, we've seen, multiple years of interest only, 5, 7, even more sometimes for select sponsors. Low 3s on the interest rate, kind of depending on
the 5 years IO. Is it lower LTV going in?
No, we've seen up to 75%.
75%, okay.
Class A product, though.
Class A product. I mean, we sold, one of the recent deals we sold in Tulsa was the Carlisle over in Broken Arrow, smaller deal.
Yeah, we bid on that. We lost.
You lost. Yeah, that's big. So it was,
That's so funny.
Yeah.
Yeah, and it was another new to market buyer out of Houston, and incredible debt terms. I can't remember how many years of IO they got, but I think it was 4 or 5, low 3s, 10-year money. That's hard to beat.
Wow.
Hard to beat. Non-recourse, obviously, to Fannie or Freddie.
Yeah.
Non-recourse. So that feels good.
So
for a lot of
what cash on cash yield is that giving your buyers that's gets driving the increase? Is they're trying to get to a yield? What is the yield on with those kind of debt terms?
Yeah, great question. During an IO period, obviously, you're typically getting really strong double-digit cash-on-cash returns. But let's just say, I mean, for a Class A deal, when that IO burns off, typically you're looking for probably a 7. A B deal, probably 8 or 9, C, 10 and above after that IO period.
And I guess it helps the longer you have IO because you're hopefully raising those rents each year. So when you come off that IO period, you've bumped your cash on cash a little bit.
Yeah, it seems like that interest only is IO, by the way. It seems like that interest only would be, crucial. I mean, just front load the returns as much as possible and then, wait for the rent growth in the back end.
It probably adds 3-4% to the cash on cash number. Do you think?
That's about right.
So just for people listening, without the IO, you're building equity at 3 or 4%. So your return may be a 7 or an 8, but with the IO, you're not paying down that equity, but your cash on cash in your hand each year is going to be 10, 11, maybe 12. So,
well, what are some of the other drivers? These guys, like you said, they're new to market buyers. So, I mean, it's hard for me to believe that we've get some new market buyer who's never been to Oklahoma, let alone Broken Arrow, and then they bid on this property in Broken Arrow. And I know it's easy to lose on deals in your own market because you're scared of the data. I mean, it happens to us all the time. We're bidding because we never think it can get to that point because we're so comfortable with it.
Yeah, we saw it when it sold at 30 a door, and so now we can't think to pay 50 a door. But the market's changing most times faster than we are.
Yeah, and it's got to be hard to give guidance to some of these buyers when you're getting so many bids, and when it's kind of hard to know what they're underwriting and what they need. I mean, they're not always just upfront with you. Hey, we need this. I mean, it's a game. There's cat and mouse there. Yeah. How much of that purchase price? I mean, how much are you guys driving that, or how much is them and the competition driving it themselves? I mean, are you guys even listing these with a price?
Typically not. We're going out unpriced. That's just kind of the reality today. It's probably the best approach. But typically, 90% of the time, it's just an unpriced deal. We give guidance, of course, once we start sending out, the offering memorandum, we give guidance. But that deal in particular traded well above our premium price on our BOV. So typically, we're very, very good at underwriting. Our financial analyst is the best. Really, really good at underwriting as a buyer would. And, we walk everyone through the numbers saying, hey, here's where you should be underwriting market expenses and so forth. And, that deal just got priced up because it was, surprised me because it was less than 200 units. Typically, that's the trigger for someone to say, I want to get into a new market. Mm-hmm. I want to amass some scale, and it doesn't make sense economically for me to invest in a deal that's 120 units or whatever it may be. But that deal was different. There was, it was lack of supply on the market and a lot of demand.
One big thing that's impressive about your group, just from my point of view on the sidelines, is your underwriting must be really good because it seems like you guys have a lot of repeat buyers that come back to you for similar type product. And obviously what you sold in the first time worked. You didn't just sell them to the moon. So, that's got to help a lot.
It does. Yeah, we're pretty straight shooters. Our buyers underwriting is typically spot on. And, typically within our BOV range, we're hitting that 90+% of the time in terms of price. But again, the market has gotten that much more aggressive during the pandemic that, okay, who wants to buy in these major primary markets right now that are essentially shut down on multiple fronts? People are moving to the middle part of the country. Population growth is escalating in all of these Texas markets. One of the top 10 markets in the country right now for in-migration, people actually moving there, is Northwest Arkansas, of all places. That's been off the radar for so many people, not to continue plugging Northwest Arkansas, but it's just a phenomenal story. So we've got, Ben McKay over there is making a huge dent for us in market share and really, really making some waves. We've sold a lot of big deals over there recently. There's a lot under construction, but still market occupancy is high 90s and absorbing everything that's built. So people love that story. People are moving there. There's jobs, there's job growth, and it's a phenomenal story.
Yeah, a lot of big companies there.
Absolutely.
Walmart, Tyson,
Yep.
Hunt.
Right.
Well, I think that's awesome. We all own multifamily. I think multifamily is a great asset class. A lot of people are pushed out of it and, would like to get back in. But overall, I think this is a good picture that we painted for why people are getting into multifamily and, why it's such an attractive investment class. I think that's great. Next episode, we are going to go over some brokerage tips. So make sure to tune in for the special part 2 of today's episode.